This is a simple savings tweak that you can employ in retirement and save tons in taxes and make more money for you. My name is McCluskey. This past year, we got 1.3 million out of banks. Here's why. First is that as of May 6th of 2025, the average saving account interest is 0.41%. The problem is that's also taxable, so it's even lower. There's a couple examples here from $50,000 all the way to $1 million of how much interest you're going to get, and then how much you're going to get after taxes in a 25% bracket and in a 40% bracket. With $1 million in a 40% bracket at the end of the year, being left with $2,460, that's not very good. Now I know what you might be thinking, why don't you just switch to a high yield savings account? Wouldn't this be a quick fix? You get more interest. Yes, it's still taxable. Yes, rates can change, but wouldn't that be the easiest thing to do? And yeah, it actually would be. And in fact, I do this with a lot of my own savings as well. However, we did mention that those rates can change. Currently, Trump has been hounding the chair of the Federal Reserve to lower interest rates. They're expected to continue to drop this year and into 2026. Regardless, though, of that, this money is still taxable. And if we are going to put this money into a bank or a high yield savings account, certainly, in order for the bank to be able to credit us this interest, they have to be profiting. That means we give the bank our money, the bank invests it somewhere, and then they pay us a portion of that interest. Otherwise, they wouldn't be in business. So instead, let's look where they're putting this money and see, could we just do this ourselves? That's exactly what we're going to get into in this video. So first, how do banks work? Second, where are they investing this money? Third, one of those places that they're putting this money, how does it work? How can we use it ourselves? And finally, when we employ this strategy, we're going to look at a real example of a couple, Lewis and Katie, that were putting $450,000 into a bank, and see that once they make this simple change over the course of 10 years, we'll end up with 15 times over that more money in their account. Let's get into it. So banks are generally not coming into existence or into the industry with large sums of cash. Instead, what happens is they get their capital from us. So first, we put money in the bank. Now the banks are not just keeping that money in a safe and locking it up until we need it. If that was the case, they wouldn't make any sort of profit and, well, they wouldn't be able to remain open. After that, the bank is going to take that money and invest it. Here are some of the main places they do that: loans, bonds, real estate, and then BOLI. We're going to get into that last one here in a second. That's actually the strategy we're going to use. From there, they are going to earn a profit. So let's say that that is 5%. Well, if they're earning 5% by putting this money in loans, real estate, bonds, and BOLI, then of course they are going to keep a portion of that money for their overhead expenses, their profit, and then they're going to credit us a small portion of that. So if it was 5%, you can see in this example, the bank is keeping 4.59% for themselves. That's going to continue to compound, and they're just crediting you 0.41%. So if banks are just going to go ahead and put money in these four things here, loans, bonds, real estate, and BOLI, is there a way that we could just cut out the bank, go directly to these sources, and earn much closer to 5% for ourselves? But since banks actually do serve a purpose and people want to use them for liquidity, and loans, bonds, and real estate most of the time aren't going to have as much as a bank might, can we still earn that return but maintain the liquidity that a bank offers us? Yes, we can, and that is through BOLI, otherwise known as bank-owned life insurance. As I mentioned there, loans, bonds, real estate, yes, they might be able to get higher rates of returns with these, but for the most part, they're illiquid. We're not going to be able to just access that money any day we want, take it out, it's in our account the next day, we can go ahead and buy groceries, pay for an emergency with it. It's just not the case. With bank-owned life insurance, that money is liquid, that money is growing, and can be accessed and transfers income tax-free, and this money is safe. I have to point out, this is not technically an investment, but that's actually exactly why banks do it. Since this is considered life insurance and not an investment, it's going to get the tax treatment of a life insurance policy instead of an investment. That means, just to name a couple of the pros here, with liquidity, we can access the money via withdrawals or policy loans, Both of those are going to be tax-free up to a certain point. Policy loans are always going to be able to be accessed income tax-free as long as you're complying with a couple laws we'll get into here in a minute. The money can't just be accessed tax-free, but it's actually growing tax-free, and when we pass away, that money, because it's life insurance, transfers income tax-free. So if you've ever had a loved one, for example, that's passed away and you or someone else has been a beneficiary of a life insurance policy they had, you would know they received that money income tax-free. Same thing with this, because it's not considered an investment, it is considered life insurance. It's not going to be able to lose due to any sort of market volatility. And there's a reason that banks are keeping much of their tier 1 assets in banks, and that's because banks themselves have a much higher loan-to-value ratio than insurance companies, basically saying insurance companies couldn't be as risky as banks even if they wanted to, because they have to keep much more money in cash. So this is a place that banks see as a nice place to keep their money, because banks, of course, they have expenses, they have employees they need to pay, they need a bank of sorts too. So why don't they just use other banks to do that? And that's exactly for these benefits here we've gone over. Insurance companies just provide those in a better fashion. So how does this bank-owned life insurance actually work? We're going to go back to another timeline here. So instead of you giving money to the bank, this time it's the bank that's giving your money to the insurance company. Then, similarly, the insurance company is going to invest that money in things like bonds, and they're going to be able to earn a rate of return doing that. Now, with that cash, though, it's going to be split up into two different categories. So your cost of insurance, because you are buying life insurance after all, and then most of it, usually around a 9-to-1 ratio, is going to go towards the cash value. The reason that you really want to make sure this is the setup is because if you put more towards the insurance, you're going to get much less growth. Yes, you're going to have more insurance, so if you pass away, well, it's better that you put more towards the insurance, but that's not really why we're doing this. We're talking about a savings account alternative, and with that in mind, we want the least amount going towards the insurance, the most going towards the cash value. Once we have most of the money going towards the cash value, that is going to get credited interest from that investment that the insurance company is making into things like government bonds. That's going to continue to compound over time, income tax-free. You can access this money income tax-free as well. And finally, over time, because this is a long-term vehicle, it's not something that's going to make sense if you're trying to do this for 1 or 2 years, but rather most likely should be something you're going to commit to doing throughout your entire retirement. If you do that, we can earn net of all fees, net of all taxes, net of all cost of insurance, up to and above 5% rate of returns annually, compounding every single year. You can access that tax-free for emergencies, opportunities, retirement income, kids' colleges, and more. Now that's bank-owned life insurance, but how can I actually do this? And that's very simple. Instead of bank-owned life insurance, you just have human-owned life insurance. If we called that BOLI, we can call this HOLI. All you're doing is substituting yourself in for the bank. You simply need to decide on your contributions that you're going to make. So whether that's a lump sum, a monthly amount, some sort of combination of both of those, pick what that is, and then finally, you'll need to go through an agent to do this, but you would apply for a policy with the least amount of life insurance possible as defined by the IRS and the most going towards the cash value. Given that amount that you're going to put in, you have to comply with TEFRA, the Tax Equity Fiscal Responsibility Act, DEFRA, the Deficit Reduction Act, and TAMRA, the Technical and Miscellaneous Revenue Act of 1982, 84, and 88. If you don't do this, that's where not enough money goes towards the cash value and too much goes towards the cost of insurance. This is very important. If that's not the case, then you might get 20 years in, look at your internal rate of return and saw you made a 1.5% year over year rate of return, and you would have been way better off just putting your money in the high yield savings if you don't structure it correctly and comply with these laws. If you do it correctly, that's how we can get upwards and above 5% tax-free, net of all fees, net of all taxes, net of all cost of insurance, year over year. Finally, then you fund your policy and enjoy the benefits. Now, this is that example I was talking about. So Lewis and Katie had about $450,000 in a savings account that was earning 0.5% interest. Now, since they were in a higher income bracket, we ran this with a 40% tax rate. That means they are earning $2,250 every single year from the bank. They're giving that to them, they're crediting it straight to their account. Now, after that 40% taxes, since this is taxed as ordinary income, they have $1,350. From $450,000, that is after taxes, 0.3% interest every year. Now, I wanted to be conservative, so I didn't go 5%. I put, what if we just did $430,000 of that $450,000, so that way you still keep $20,000 for any sort of emergencies, opportunities. You have that money there, it's super liquid. Not that this $430,000 isn't liquid, it's just usually you're gonna fill out a form, checks in your mailbox in the next day or two, but it's not immediate like the money that's in a bank. So if we kept $20,000 there, maybe that isn't a high yield savings, so that's continuing to grow as well. We're not even accounting for that. And we moved it into a vehicle that's getting 4% year over year, but compounding tax-free as their savings vehicle. They're going to get $17.2 thousand before taxes, but since this is in bank-owned life insurance, or in their case, human-owned life insurance, they don't have to pay any taxes and they can access it tax-free. So they're going to get that full $17.2 thousand each and every year. That's going to continue to compound. Comparing this, after just 1 year, so the 17.2 divided by the 1350, they have 12.74 times more money. After 10 years, compounding this out, they have $206,505 in interest, completely income tax free. Comparing that to if you just compounded this 1350, they've got 15.09 times more money than they would have if they hadn't employed this strategy. And that gap would just continue to get bigger and bigger over time. Finally, some warnings. Now, with this strategy, the structure is the biggest thing. I hammered that down a little bit earlier, but if you are not putting enough money towards the cost of insurance and too much is going towards the cash value, then this is considered a modified endowment contract, and you are going to have to pay taxes when you try and access the money. If you are putting not enough towards the cash value and too much towards the cost of insurance, well, you're going to end up with an insurance policy that you probably don't need, and hey, it's going to benefit you greatly if you pass away earlier, it's going to benefit your heirs, but that's not the goal here. So if that's the case, you're going to get much worse internal rate of returns just because you're buying way more insurance than you actually need. You're not using this as the savings account strategy that we've gone over in this video. If you have it structured with roughly that 9-to-1 ratio there, you're complying with those tax laws I mentioned, you're good to go. Second here, this is a big thing, is that this is a long-term vehicle. Over the course of 5 to 10 years, you're not going to see incredible internal rates of return. The reason that is think of it like a mortgage on a home where there's all the interest kind of paid up front. Same deal with these policies. After those first 10 years, for example, and this varies from company to company and product to product, once all of that interest is front-loaded in fees and cost of insurance, once that's gone, that's where you start to see 0.1, 0.08, 0.09% a year that's actually being taken from your cash value to go towards cost of insurance and policy expenses compared to the much heavier amount that's happening up front. Now, retroactive back to the day you begin the policy, usually about 30 years in, that's where you're going to be able to see, again, retroactive back to day one, a net of around a 1% fee for the money that you're putting in every single year. That means if your account gained 6% year over year for the last 30 years, you're going to see a gain as if you only earned 5% the last 30 years. Still, that money's happening completely tax-free. Compare that to a financial advisor, for example, that's taking a 1 or 1.5% fee every year. You also have your taxes. And if you cut both of those things out and you're really sticking this for the long haul, that's where you start to see the benefits. Hopefully this video was helpful. If you did enjoy, be sure to subscribe. I release videos twice a week now, putting in way more preparation into each and every one of these videos so that you, the viewer, can get the most out of them and really make sure that you're prepared to make informed decisions for your retirement. Please do subscribe, and I will see you in a future video. Bye-bye.